Are you wondering how our housing market in Waterloo Region did in 2023? Well, I'm going to tell you all about it starting right now. Hey, it's Andrew Shackleton, Kitchener Waterloo real estate broker, Drew at home.com. So, this is my 2023 market update for Waterloo Region across the board. How did our housing market do? First off, I want to start off with just the month of December to close that out, because I normally do a month-over-month video, and good time as any to kill that off right now. December was a slow month, just like December 2022, very similar, low sales volume. Prices held up reasonably well, mind you, despite the slowness. We were down roughly $40,000 on a month-over-month basis compared to November for detached properties. Semis and townhouses came in dead even, and apartment-style condos came in at, I think, 40 grand higher than December. So quick rundown on those prices. Detached, 850,000. Semis came in at 613. Townhouses came in at 617,000, and then apartment-style condos came in at 490K. Now, looking at market activity for the entire year for 2023, relative to 2022, 2021, etc., we're down worst case by roughly $60,000 compared to the 2022 values. So I believe detached came in right around $920,000, if I'm not mistaken. And like I say, the prices are pretty much mirroring 2021, just slightly higher. I'm going to put up graphs, of course, so you can check out these figures yourself. The big tail, though, for 2023 versus the past 5 years, the big tail is sales activity. That has really fallen right off a cliff. I had mentioned at the start of the video that 2022 was slow. Well, 2023 was even slower. On the 5-year average, worst case was semis. We came in 27% lower on volume for that, 19% lower for detached, 17% lower for townhouses, and then lastly, we were 9% lower for sales of apartment-style condos. So big drops in sales activity, and with regard to prices, as I just mentioned, we've held up remarkably well, and we're sitting somewhere around 2021 values. This slowdown in sales volume, though, it's had some effects for buyers, which is a good thing, and no question buyers are thinking this is long overdue. For the past 3 or 4 months here in Waterloo Region, we've actually had what's known as a neutral or balanced market. That's defined as 3 to 5 months worth of unsold inventory, and we've had that. The crazy thing about this, though, is we haven't seen that in the fall of any year since 2014. So that's really giving you an indicator of how red hot our market was prior to the interest rate adjustments that the Bank of Canada started making in the spring of 2022. Other metric, of course, that ties into this is days on market. I think November we were somewhere around 24 days on market to sell. December was slower still, but I mean, it's Christmas, and nobody's surprised by that. But we were around 30 days to sell a property in December. And if you think back to 2021 or 2022, we were selling properties in 7 days. So despite our relatively high prices, this is giving buyers a lot more choice and a lot more flexibility as far as being able to walk away from deals if they don't want to do the multiple offer thing. Obviously, sold to list ratios have come way down as well. We're down around 100%, if I'm not mistaken, and certainly other years we were at 115, 120% of your asking price. So this has definitely been good news for buyers. So that's where we're at sales-wise. That's where we're at, sales volume-wise and prices as well compared to 2022. But looking back, to 2019, pre-pandemic, we're still well over 50% higher than we were prior to the pandemic. That kind of thing, the pandemic, that leads into my next little segue I wanted to talk about. Factors leading into why prices are so high. I put a video out and a blog post right early January 2022, and my thesis at the time was that interest rates were driving prices through the roof, and I still think that's completely true as far as how high prices had gotten. We had interest rates at 1% or less for 10 years of the last 14, and that's definitely blowing fuel into the fire, as the saying goes. One thing I hadn't looked at back then that I looked at this morning, though, was what they call the M2 money supply. And along with those super low rates and COVID spending and government programs all brought in because the stock market, if you recall, in early 2020 had tanked. And the feds and our government too, of course, just piled money into the markets to hold things up and slash interest rates. So there's this big spike in what they call the M2 money supply, right when we were seeing 20 and 30% gains in our housing costs each year going into 2022. So definitely government factors and COVID have created the market that we're in right now. So that having said that, what they've done since then is raised rates by 10 meetings out of 14 or 15, they've raised rates by over 4%. And right now, the overnight rate is 5.25%, if I'm not mistaken. And you can get money on a 5-year fixed between 6 and 5.5% if you're shopping around for the cheapest lenders in the province. Now, talking about all that, high interest rates, prices have held up regardless. And what's behind that? Well, we've got several factors going on. We've got very high immigration into the country, so much so actually that the Deputy Bank of Canada governor had actually talked about this maybe 3-4 weeks ago, which I was surprised at. Tiff Macklin, the governor, he had actually mentioned about 3-4 months ago that he was surprised prices haven't come down. I certainly think that the government at all levels, provincial, federal, locally, they haven't built enough infrastructure to meet demand, and there certainly isn't enough housing to meet demand either. So that's certainly keeping upward pressure on prices, no question about it, despite the high interest rates we're seeing. Now, what about what's going to go on in 2024? Well, down in the States, Federal Open Market Committee, they have talked about lowering rates in 2024 and 2025. I could see that happening. Some pundits were saying a few weeks ago there was going to be 6 decreases of roughly 25 basis points each time. I read this morning that no, it's only going to be 2 or 3. But either way, they're talking about lowering rates in the States over the next 12 to 24 months. I think the same thing is going to happen here, absolutely. What the feds do, we in Canada also must do. And I think our Bank of Canada is going to do the same thing, and we're going to come down 0.25 at a time. A rate decreases slow like that, like going down a step, I don't think it's going to be enough to suddenly cause a huge spike in prices, despite the fact that we've got high immigration. I think a lot of Canadians right now are strapped for cash. We're still in a relatively, they can say inflation's benign at 3%, but costs have shot up over the past couple of years. And I think people are feeling that. And there's a bit of a wariness and caution in buyers that perhaps we didn't see 2 years ago. So I could see, even though we're having rates come down a bit, even though we've got high immigration, even though we have insufficient supply, I don't think the market's going to go crazy this spring. I think, we could see, some activity as you typically see in a spring market, as far as it being busier and as far as prices coming up. But I don't see the craziness like we saw prior to 2022 happening. I think we're going to have a typical slower than normal year with prices coming up moderately. That's my forecast. We'll see what happens. Anyways, that's a lot of stuff to digest. Sorry for super detailed videos. Sometimes it's like that. Thank you so much for watching. Have yourself a fantastic day, and we'll catch you on the next one.